the United States has just been hit with another financial shock, and this time, it didn't come from Wall Street, Silicon Valley, or even Beijing. It came from Tokyo. Japan, one of America's closest allies and historically one of its most dependable financial partners, just sold off a massive chunk of U.S. Treasury bonds. This wasn't a small adjustment, it was a staggering reduction, over $119 billion in a single quarter, the steepest sell-off in more than a decade. And the ripple effects were immediate and brutal. Within days, the U.S. stock market shed nearly $1.7 trillion in value. Bond yields surged to levels not seen since before the financial crisis of 2008, and suddenly, the world's faith in America's financial stability was no longer unshakable. Investors around the globe began asking a question that Washington hoped would never be raised. If Japan no longer trusts U.S. debt, why should anyone else? To understand how we got here, you need to see the bigger picture. For decades, Japan has been one of the pillars supporting America's debt-driven economy. Every month, almost like clockwork, Tokyo would quietly buy billions of dollars of U.S. Treasuries. These purchases weren't charity. They were part of a delicate balance, a way for Japan to keep its own currency weaker, its exports more competitive, and its alliance with Washington firmly in place. But the foundation of that arrangement is cracking. In January 2025, according to Treasury International Capital data, Japan slashed its holdings by nearly $120 billion. To put that in perspective, that's enough to cover the annual budgets of multiple U.S. states combined. Once the single largest foreign holder of American debt, Japan has now been overtaken by China, and that shift carries enormous symbolic weight. A loyal ally, once the bedrock of U.S. financial credibility, is pulling back. The Bank of Japan gave a technical explanation, pointing to domestic yield curve adjustments, but leading economists argue that this wasn't just about interest rate mechanics. It was a deliberate hedge, a signal to Washington that Japan is preparing for a future in which U.S. fiscal instability is no longer a risk. It's a reality. This financial retreat didn't happen in a vacuum. For months, Japanese officials had been quietly warning that America's erratic trade policies and the dollar's growing volatility were making it impossible to plan long-term. And then came the breaking point. In late 2024, the United States imposed a heavy tariff on Japanese electric vehicles, citing so-called unfair subsidies and national security threats. For Tokyo, this was a slap in the face. Japan, a close ally hosting thousands of U.S. troops on its soil, was suddenly treated like a strategic adversary in trade. Japan's Ministry of Economy denounced the tariffs as disproportionate and unjustified, and auto executives openly warned that this would disrupt supply chains built over decades. It wasn't just about cars, it was about trust. The timing couldn't have been worse. Japan had just unveiled breakthroughs in solid-state battery technology, with Toyota and Panasonic announcing prototypes capable of ranges and charge times that could leave U.S. automakers struggling to keep up. American giants like Ford and GM were already dealing with supply bottlenecks and soaring costs due to Chinese restrictions on graphite exports. The idea of Japanese EVs dominating global markets while U.S. manufacturers fought uphill battles was politically toxic in Washington. And so, tariffs were wielded as a defensive weapon. But Japan didn't retaliate with auto parts or consumer goods. Instead, it chose the most strategic weapon it had, U.S. Treasuries. By selling down its holdings, Tokyo sent a message louder than any press release. America's financial dominance is not guaranteed, and even its closest allies are willing to use debt markets as leverage. The results were immediate. In early February 2025, U.S. 10-year bond yields spiked to nearly 4.9%, the highest in almost 2 decades. For ordinary Americans, that number might sound abstract, but the consequences are painfully real. Higher yields mean higher borrowing costs for everything: mortgages, car loans, credit cards, small business financing. The Congressional Budget Office warned that if yields remain elevated, U.S. debt servicing costs could balloon by more than $270 billion annually by 2027. That's money that won't go to infrastructure, healthcare, or education. It will simply go to paying interest. And once markets see a major buyer like Japan retreat, others start to wonder if they should too. South Korea, the UAE, even European banks began trimming their dollar reserves, while the dollar index slipped more than 2% in just 2 weeks. A small drop on paper, but a symbolic blow to the idea of the dollar as an unquestioned safe haven. The stock market felt the pain almost immediately. Between February 3rd and February 6, 2025, U.S. equities lost over $1.7 trillion in market capitalization, with the S&P 500 falling more than 5% in just 3 trading sessions. Investors weren't just reacting to the bond sell-off. They were spooked by the broader picture: rising tariffs, escalating trade disputes with both Japan and South Korea, and a White House signaling even more economic confrontation ahead. Credit agencies like Moody's placed the U.S. outlook on negative watch, citing ballooning deficits and geopolitical instability. BlackRock analysts warned that policy unpredictability was now the single biggest driver of market risk. Suddenly, what had once been dismissed as political noise became systemic risk. Behind the headlines lies a deeper trend: the slow but steady erosion of the dollar's dominance. In 2022, the dollar accounted for nearly 60% of global foreign exchange reserves. By 2025, that share had slipped to around 57%. It's still dominant, yes, but the trajectory is clear. Central banks from Brazil to Malaysia are quietly increasing their holdings of gold, yuan, and other assets. China's digital yuan has begun to account for a small but growing share of cross-border settlements in Asia, while India has inked oil contracts in rupees with Russia and Iran. These aren't yet existential threats, but they are warning signs. The world is diversifying, hedging against the possibility that the US dollar is no longer the one currency everyone can rely on. Japan's massive Treasury sell-off poured gasoline on that fire. This crisis has exposed something that was hiding in plain sight. America's economic engine has been running on debt, not discipline. During the boom years of 2017 to 2019, corporate tax cuts fueled short-term growth but also ballooned the federal deficit to nearly $1 trillion annually. By fiscal year 2024, that deficit had surged to almost $2 trillion. Without structural reforms, the U.S. has been depending on foreign creditors to bridge the gap. But what happens when those creditors walk away? Canada, another close ally, is already hedging by deepening its integration with Europe and the Indo-Pacific. In early 2025, Ottawa signed agreements with the European Central Bank and the Reserve Bank of Australia to enable direct digital settlements, bypassing SWIFT and reducing exposure to U.S. financial turbulence. Trade data shows Canada's exports to the EU rising while exports to the U.S. are slipping. As Canadian Finance Minister Chrystia Freeland bluntly put it, resilience today means not being overly dependent on any single economy, even an ally. That is not betrayal, it's self-preservation. Meanwhile, Washington's approach has been to double down on tariffs and confrontation. In January 2025, the administration announced a 200% tariff on European wines in retaliation for EU fines against American tech giants. Europe responded with threats to target U.S. pharmaceuticals and aircraft components. In Asia, new tariffs were floated against South Korean semiconductors, sparking fears of a broader trade war that could disrupt global tech supply chains. Courts attempted to intervene, with the D.C. Circuit ordering a pause on some tariffs, but the White House pressed ahead under national security powers. Legal scholars warned that this defiance of judicial rulings undermined confidence not only in trade policy, but in the rule of law itself. Even Chief Justice John Roberts issued an unusual public warning against executive overreach, cautioning that if America's own institutions appear unstable, global markets will lose confidence in U.S. governance as much as its economy. At the heart of all this is a simple but devastating truth. Credibility is the real currency of global finance. The U.S. dollar still dominates global reserves, but every time allies like Japan choose to sell treasuries, every time courts are ignored, every time deficits expand without a plan for discipline, a little bit of that credibility erodes. Investors and governments worldwide are watching closely, asking whether the system that has anchored global trade for nearly 80 years is still as unshakable as it once seemed. Former Fed Chair Janet Yellen put it starkly: the U.S. won't lose dollar dominance overnight, but the world is already shifting into a more fractured era. If nations increasingly bypass the dollar, the U.S. won't just lose transaction fees, it will lose leverage. And once leverage is gone, it can't easily be reclaimed. So, where does this leave America, and where does it leave the rest of the world? If the dollar is no longer the unquestioned center of gravity, then we are heading toward a world of contested spheres, multiple financial systems coexisting uneasily, and constant bargaining over who sets the rules. For some, that means opportunity. For others, it means instability. Japan's decision to sell off U.S. Treasuries is not the end of the story, but it may well be remembered as the moment the balance began to tilt. Not a collapse, not an overnight revolution, but the first visible break in a system long assumed to be permanent. The next moves, from Beijing, from Brussels, from Riyadh, from New Delhi, will decide how fast that break widens. And here's the question that every policymaker in Washington should be asking, and that every investor should be thinking about. If even America's closest allies are preparing for a future without dollar supremacy, what happens when rivals decide to accelerate that process? The answer, for now, is uncertain. But the trajectory is unmistakable. The world is no longer waiting for America to lead. It's preparing for a future where America is just one power among many. That is the true meaning of Japan's sell-off. It wasn't just a financial adjustment, it was a geopolitical statement. And if Washington doesn't take it seriously, the cost won't just be measured in lost trillions on Wall Street. It will be measured in lost trust, lost influence, and lost time to adapt to a changing world. Because in the end, markets don't only run on money, they run on confidence. And confidence, once broken, is the hardest currency of all to rebuild. This is the moment to ask yourself, are we witnessing the beginning of the end of American financial supremacy, or just a painful reminder that even empires must learn to live within their means? The answer to that question will shape not only the next election cycle or the next quarter's earnings, but the very architecture of the global economy for decades to come.